Hello. Today we are going to be talking about the Piotrowski F score, and in particular, engage with our engage portion of my presentation, my slideshow. And so the main academic standards that we are going to be covering for this section are the applying strategies for creating wealth and business building assets, as well as the one of comparing investment alternatives. The learning objectives that we will be focusing on are comparing and contrasting the profitability of stock investments with the Piotrowski F score, and evaluating the role of investments in building business profitability. And so to start off, we're going to be watching this video from 2 minutes to 4 minutes and 10 seconds.
Let's look behind the scenes of the F-score and determine how these numbers are derived. The score was created by Joseph Piotrowski, a professor of accounting at Stanford University. The F-score is made up of 9 variables from a company's financial statement, and 1 point is awarded for each aspect which passes the criteria set. The 9 variables are split into 3 groups: profitability, leverage and liquidity, and operating efficiency. First, we have net income. If there is positive net income in the current year, the company gets 1 point. Next, operating cash flow. Positive cash flow is required from operations in the current year. Return on assets. Current return on assets must be higher than the previous year. Quality of earnings. Cash flow from operations must exceed net income. Decrease in leverage. If the ratio of long-term debt is lower than the previous year, we get 1 point. Increase in liquidity. If the current ratio is higher than last year, we get 1 point. Absence of dilution. 1 point is given if the company did not issue any new shares in the preceding year. Next, we have operating efficiency. If gross margin is higher than the previous year, we get 1 point. And finally, asset turnover. If there is a higher asset turnover ratio year on year, 1 point is given. The key to these scores, which is perhaps absent from other methods, is that we're looking for momentum within the aspects, and with many which can be easily filtered against. I personally use Stockopedia for such analysis, and they provide detail for each stock based on the Piotrowski F-score. A point is given if the company did not.
So the key things that I want you to pay attention to are the 3 aspects of Piotrowski's F score, mainly profitability, leverage and liquidity, operating efficiency. These 3 aspects represent key areas in how businesses create money and generate wealth. One of them is that the business must be profitable, meaning that it must earn more revenue than it earns expenses. Number 2, the business must have a low amount of debt. That way, the business does not seem to be swamped in leverage. Third, the operating efficiency must be operating efficiently. That way, meaning that the business must do what it does best and do what it does most efficiently. And so all these 9 variables, if the Piotrowski F score, if the company fulfills each of these criteria, then we add 1 point from a base value of 0. And so next we're going to listen to the wise words of Martin Luther King Jr.
Piotrowski F score is made up of 9 criteria and 1 point is added for each criteria. The company fulfills the criteria are as follows. 1. The company has a positive net income. 2. The company has positive operating cash flow. 3. The company's return on assets is higher than last year's. 4. Cash flow from operations exceed net income. 5. The ratio of long-term debt is lower than the last year. 6. The current ratio is higher than last year. 7. The company did not issue any shares. 8. Gross margin is higher than last year's. 9. Total asset turnover ratio is greater than last year's.
So as you can see, what Martin Luther King Jr. is basically telling us is each of the 9 criteria that the ratio must follow. And so lastly, we're going to try and apply the knowledge that we learned by completing these Padlet questions that I created. And we're going to refer back to our video to help us answer these questions. So our first question is that suppose that a company has a positive net income, negative operating cash flows, return on assets less than the previous year, has cash flows greater than net income, and has issued new shares. What is the company's F score? So right off the bat, we know that the company's F score is not going to be 0 because the company has indeed issued new shares, meaning that we need to add 1 to our base value of 0. And so our second thing that we're going to look at is whether the company has a positive net income. And as we can see, the company has generated a positive net income, which means we're going to add a base value of 1 to the Piotrowski F score. And so the second thing that we're going to look at is what the return on assets is less than or greater than the previous year. We can see that the return on assets is less than the previous year, so we're not going to add a point at all, since a Piotrowski F score, 1 point for the Piotrowski F score would mean that return on assets is more than it is than the previous year. The third thing that we're going to look at is whether or not the company's cash flows is greater than net income. And as we can see, the company's cash flows are greater than net income. And so this means that it has a positive operating cash flow, which means we're going to add 1 point. And so in total, we're going to add 4 points. So this is going to be 4 points, and we're going to answer the question. We're going to say it's 4 points. And we're going to publish this, and that's going to go below this one over here. So we're going to move this over here. And so our second Padlet question is asking us how many criteria are in the Piotrowski F score. And so obviously we have our list of our first criteria is that, as we can see from the video, it's that our first criteria is that we have a positive net income. So we're going to write that down. Positive net income. Our second criteria is that we have a positive cash flow, right? So positive cash flow is another one. Our third criteria is that return on assets is greater than it is the previous year. Our fourth criteria is that the cash flow is greater than net income, right? Cash flow is greater than net income. And our fifth criteria, where we move on to leverage, is that we have debt less than the prior 12 months. So less than prior 12 months, meaning that we have less debt than we had in the past, essentially. That's why it's on the leverage section of our F score criteria. Our sixth criteria is that liquidity is greater than it has been in the previous 12 months. So liquidity is greater than prior 12 months. Our seventh criteria is that there have been no new shares issued. Our eighth criteria whereas when we were getting the operating efficiencies, that gross margin is greater than it has been the previous year. And our ninth and final criteria, the asset turnover ratio is greater than it has been the previous year. Yep. And so we are going to publish this.